Hello, everyone. It's Larry Kotlikoff back with Economics Matters, the podcast. I'm delighted to have Allison Schrager with us today. Allison is a senior fellow at the Manhattan Institute and a City Journal contributing editor, where where her research focuses on public finance, pensions, tax policy, labor markets, and monetary policy. That's a lot of topics. She's also the author of An Economist Walks Into a Brothel. We'll have to talk about that one. Um, in the past, in prior years, Allison was a journalist at Quartz. She led retirement product innovation at Dimensional Fund Advisors. She has consulted to international organizations, the OECD and IMF, for example. She's been a regular contributor to The Economist, Reuters, Bloomberg, Businessweek, and her writing has also appeared in Playboy, Wired, National Review, Foreign Affairs, and City Journal. Allison received her undergraduate degree from the University of Edinburgh in Scotland and her PhD in economics from Columbia University. Welcome, Allison. It's just great to have you.
Great. Thanks so much for having me. I'm such a big fan, so of your
Well,
work
I'm
and
a
of your
huge fan.
podcast. I
You
mean,
know, I've
obviously,
been, oh, sorry, go ahead.
no, as I said, I've been, reading your work since grad school, and so it's such a pleasure.
Well, thank you. But I've been having a lot of fun reading your articles because when you see commentary about economic issues, uh, it's never by an economist, and you have a PhD in economics, and it shows immediately that you know what you're talking about. And so many other, there's only a few people in the country who write um, about economics. I don't think there's anybody, or perhaps, besides you, write routinely at this point to these major publications that has a PhD in economics, and it just shows through pretty much in every sentence. So it's
That, thank you. That's like the best compliment you could give me because you work so hard at it, and both the training, both like what you do after, and then communicating it was learning how to do that was a whole nother skill. So it means
yeah,
everything. You think it all shows.
yeah, it does. So you've worked a lot on retirement economics, and you said before we got started here that retirement economics is kind of the problem with that is kind of a metaphor or a way to think about the problems for the broader economy, maybe not just domestic, but not international. Uh, you want to riff on that a little bit, but maybe give us a little background before you start into that on how you decided to go into economics, where you grew up, and your career.
Yeah, like I think a lot of economists, I grew up in the midst of a market failure, and I think that always excites people, sort of it raises questions that I think when you find economics, it starts offering answers, which I think is what inspires people. I'm from northeastern Connecticut. I grew up in Storrs, which is where UConn is, although my parents aren't professors. Um, but northeastern Connecticut, sort of deindustrialized before a lot of the rest of the country. And so there was this big university. There was a lot of poverty that was very persistent and also a lot of resistance to development. And in theory, you think, well, Eastern Connecticut lost a lot of its industrial base, but it had a huge world-class university. Like that should have the switch to the service economy should have happened there. Like, there's no reason why stores couldn't be like perhaps like Ann Arbor. I mean, and that didn't happen. And I was unusual growing up there because I was most people there are multi-generational unless you're affiliated with the university. And I had professional parents and was multi-generational, which was, I guess, very unusual because there was a very bimodal income distribution. Like either you were upper middle class and associated with university, or you really didn't have much money at all. And if you didn't have much money at all, you were from there. And I was from there, but in the, I guess, other tail. So I always felt a connection to everyone. And the persistence of the poverty bothered me a lot as a kid. I really couldn't figure it out But then I also sort of saw the town sort of thwarting any development, either commercial or just retail, even at every turn. And as I said, the sort of the income differences really bothered me, and I couldn't figure it out. And then you start studying economics, and it all starts, I think, making sense. I took my first economics class when I was 16, and that was just it. I've actually not really studied anything else since. I somehow managed to arrange my classes in high school where I only studied that. I went to the UK for undergrad, so I only studied economics, then I did a PhD. So it was just it, because it just excited me so much that I was finally getting to figure things out, started to understand what went wrong in the community I grew up in. And I always felt like I'd keep going until I felt like I've learned enough, and I'm still not there. So it's such a great gift. I think it was the smartest thing I ever did when I was that young, to think this is what I want to do. And
Well, they actually had high school economics courses.
I went to a boarding school, so we had
Okay.
a lot of them. More than, I mean, I was lucky that I had that option to take not only economics classes, but several ones as in high school. And looking back, I'm not sure how well taught they were actually, but it got me excited about the field, and that's what matters.
Cool. And so what do you think went wrong with stores in terms, we shouldn't leave stores Connecticut until we kind of you've raised a bit of a mystery puzzle here, why there was so much opposition locally to development.
It was just like hardcore NIMBYs. It was a rural community, and you had people who just wanted it to be a rural community. And I think in the end that's why we didn't turn into, I mean, maybe not Ann Arbor because we didn't have the auto industry nearby, but some version of that.
Mhm.
Um, and I think in retrospect, their NIMBYism, I think, really is what made sort of northeastern Connecticut, I think the economic, I don't say basket case, it's not quite, maybe not that bad, but pretty bad, and still
Yeah,
is. It's the only, I think, region that just voted for Trump in Connecticut. No judgment there, but I think it just says it's a very different region than the rest of Connecticut.
right. Okay, so tell us this connection you see, or tell us, you're thinking about retirement economics. It's a big interest of yours, and then maybe riff on how that connects to the broader economy. Because just for people to know, if you go Google Allison Schrager, and you'll come to a site right at the top, Manhattan Institute, at Manhattan dot Institute,
Mhm.
and you'll see her, I guess, webpage there, and you'll see her articles listed. A lot of these are, I guess, in Bloomberg, but just let me give you some of the titles here. Just in the last few weeks, the Bitcoin bubble isn't all about Trump. Trump's appeal to young men in three charts. America's free lunch economy is over. The art market needs a restoration project. Econ discussion with Bill Easterly, one of the top, I guess, international economists, right?
Mhm.
Uh, Populism is bad for economic growth. Unions need to join the 21st century economy. Algorithms don't raise rents, landlords do. Uh, it just goes on. Sovereign wealth clubs. The Fed is no longer the only game in town. So, and this is just since August. I mean, and I've only read like half of the titles here. How the Treasury is more powerful than the Fed. Uh, so, and each one of these is kind of uh, breaking new, breaking your brain. I mean, it's just coming up with new insights that you would not otherwise have thought about. And I like to pride myself in trying to think, out of the box. And I'm learning a whole lot listening, reading this stuff. So anyway, go ahead. Tell us about your interest in
Well,
retirement economics and its connection to the broader economy.
yeah, well, as I said, a weekly column forces you to think about things, I think.
Yeah.
So I started doing retirement economics. I was a research assistant summer in college with Casey Mulligan when he was doing some Social Security work with Xavier Sally Martin. And that got me thinking about the problem. And I guess it's a strange problem to get entranced with when you're 21, 22. I can't remember. But I just liked it because it just sort of, economics is sort of an overwhelming field to take on when you're young, or ever. And I just sort of liked, I just found it interesting. Then I was doing Social Security work, um, and thinking about, what's the best way with Casey of, how should the state provide retirement benefits? Um, and then the next year I started grad school and then worked at Bank of England for a bit on they at that point they were doing a very fast move from defined benefit to defined contribution retirement plans. So that was the question I got into in grad school, was this big shift from defined benefit to defined contribution. And though it's, when you think about it properly, which is a great gift of graduate school and academia in general, is you really can think about what does that mean to go from defined benefit to defined contribution and what would be optimal. And in this way, I think the retirement problem really is, generalizes to everything, because it's sort of in some ways small, in some ways simple, but then not, in that you start your life, you get paid a certain amount that's uncertain, you face financial markets that's uncertain, but you need to make resources last a lifetime, and or consume, I guess, consistently throughout a lifetime, I guess is more the objective, and do that with as little risk as possible. And isn't that, like, economics is the optimal allocation of scarce resources under risk and uncertainty? So that is every economic problem. I mean, that's, what's happening at the macro level, and it happens at the individual level, but also how an individual thinks about these things also has bigger macro implications or is solved by the macroeconomy. So it's like it seems so simple, like personal finance, um, to start with, but then as you really delve into it, you get these intricacies. Like in grad school, I would have called my fields macro public finance. So I was thinking, what's optimal in terms of defined benefit versus defined contribution, what's the best structure for an
And
individual.
just for everybody, a defined benefit would be like a traditional pension. So you would work for a company and that would give you a pension, or you'd work in your job and the government would give you a pension. Now, whether they got you to pay for it out of your contributions, or whether they, took your contributions and use those to pay the pension for older people, that's our Social Security system in a nutshell. Kind of take as you go, take from the young and give to the old. But the defined contribution is generally more fully funded, where you just put in money into your own account and then you take that out. It's like a 401k type plan. Anyway, go ahead.
Exactly. And can see how this becomes something that seems so simple. How do you save for retirement? Quickly becomes, who should bear risk? What's the best way to structure that? Is it better for an individual? Is it better for the government? Is it better for your employer? What sort of risks does each pose? It quickly becomes a very big question. And then after grad school, I worked with our mutual friend, Robert Merton, and he saw it from a completely different perspective, just a pure risk perspective. And I worked with him for 7 years, working on different retirement products. And uh, that was just, a mind-blowing, time with him that I think took me to another level as an economist, or several levels, because he's, just being around him is so amazing. And I also resaw the problem as a pure risk problem. And that really, I think, changed my view as an economist. I call it my conversion from macro public finance to just finance. I consider myself a financial economist anyway. It wasn't my formal training, because I think my time with Merton really made me feel like risk was everything. And this problem of retirement is primarily a risk problem. But because I can generalize um, retirement economics to bigger macro questions, you can also see how those become risk problems too.
Yeah, I mean, certainly, what everybody's facing who's collecting Social Security, 77 million people are being told that in just 2033 or 2034, about 10 years from now, the system is going to be short uh, on a cash flow basis. They're going to be out of money and need to have a benefit cut of 21%. And President Trump wants to, at least he said he wanted to reduce the taxation or eliminate the taxation of Social Security benefits. And that would lead to a shortfall of 33%. We need a 33% benefit cut starting in 2031. So that's, here we are trying to decide what to do, how much to save, so we can be like a squirrel and continue to eat acorns through the year, even though there's none on the ground, it's winter, you can't find them. But one of the basic underpinning of our retirements is up for grabs here. We don't know exactly how it's going to get resolved. Although I don't think it's going to be through benefit cuts
No,
politically.
no, it never happens. It's like I feel like whenever there's any sort of fiscal crisis, not that necessarily we're going to have one, pensioners always get paid first. Um,
Yeah,
so
they vote.
that's the
You know,
true debt hierarchy that people don't always put into with bondholders, pensioners. Um, but it's the cognitive dissonance is amazing. Like everyone says, "Oh, I don't know if Social Security is going to be there for me." Even people already retired because of this looming um, cliff. But at the same time, people want politicians who promise not to touch Social Security. So, um,
yeah, it's like this. I mean, part of what I wanted to ask you about retirement. I realize there are these kind of real risks that people face, rates of return, and yes, about the government pensions. But then people seem to be like deer in the headlight and not be able to sit down and plan. That seems to be true of everybody, not of everybody, but of maybe like 95% of the population has a very difficult time sitting down and saying, because I think they're so terrified to look at it or so sure they're fine, and when there may not be, that uh, they just shut down, and it seems like the economy's shutting down, or the politicians are shutting down, or the entire nation, the voters are shutting down when it comes to making a decision before a crisis. It's like, let's wait till I retire to decide to look at my retirement. I've
yeah,
got colleagues in my economics department. They have our free Maxify Planner software, which I think is perfect for consumption smoothing and maintaining your living standard, just having upside risk via risky investments. So there's lots of cool things you can do, including getting free extra Social Security benefits by being smart about what to take and when, and lowering your lifetime taxes. A lot of them don't use it because they just don't use it. They don't do any planning. These are PhD, these are full faculty, full professors in my department. So it seems like I have to kind of sit down with, this is now my idea, which is to sit down with each one of them and hold their hand and run the program for them to get them.
have you done that yet with anyone?
I'm starting to schedule, so I would say it's financial psychiatry sessions.
It's so, I mean, we could talk about this later. I think it's one of the reasons why AI will never fully replace planners, because I think me forcing people to do that is one of their huge value adds. Um, but I found like I haven't done something nearly as complex as what you're gonna do, but I find just even at Bloomberg, a 25-year-old colleague who's afraid to sign up for a 401k, and I sat down with her to do it, and she just loved it at the end. She's so excited about it now. So
Uh,
she had all of the psychological barriers of I don't want to think about getting old, I don't want to tie up my money, all the things. And now she's into it. But I think this also speaks a lot to sort of broader economic problems again, because I said that the retirement problem is so hard, yet it's also not like you and I could like hash this out. You built a program that can help people save and get consistent consumption smoothing. You've solved the problem. You and I could probably work out a plan for Social Security in a couple hours. Like all of these problems are actually, for a complicated problem, we pretty much know what this great thing about being retirement economists, you know what to do. We've fixed it, we've solved it. Yeah, like no one listens to us, so it remains to be a problem, which I guess is good for our job uh
Security,
opportunities.
yeah.
But mhm.
Yeah, I mean, now we think about the Treasury Secretary about to be appointed, people with no background in economics. So they know how to do trades on Wall Street, but can they think through these kinds of issues systematically? Not at all. And
Yeah,
so, and we've had Janet Yellen, who's a top economist and a close friend of mine, actually, but her ability to even cut through uh, that political, wall that was surrounding President Biden. He had all kinds of people limiting access to him. You had my sense is um, that there were certain people that maybe it was his chief of staff or whatever who was deciding who he could see and uh, and not see, and what he could discuss and not discuss. And so I think in many, he got a lot of things, major things accomplished, but lots of things never got touched or thought about, and there was no real thinking out of the box. A new infrastructure bill. Well, we have a new infrastructure bill every 10 years because they run out, right? So so it sounds new, but it's actually old, right? There's not that much new. You have to repave the highways. But to think about, should we, uh, basically shut down the old Social Security system and set up a new one? Should we reform the tax systems fundamentally? Should we go for maybe Medicare Part C for all, the Republican version of Medicare for all? These are big questions that economists have been talking about, but nobody there never came up. Let's talk about retirement for a minute. It's something Americans think about regularly. Ask yourself, how financially secure do you really feel? Do you have enough money to retire? How much is really enough? And if you don't have enough money, how can you possibly find that extra money before you do retire? These are all tough questions. My retirement software, Maxify Planner, is the powerful online planning tool that takes the guesswork out of retirement. It weighs your assets against your fixed expenses to calculate how much you can safely spend every year for the rest of your life based on when you decide to retire. And it shows you safe ways to find more money. Maxify makes a complicated problem like retirement planning simple. It's accurate, easy to use, and produces what you really seek, peace of mind. So make the smart choice and visit Maxify.com today. Don't miss this opportunity. That's Maxify with an I, Maxify, Maxify.com. Now let's get back to the podcast.
Yeah, it didn't get the sense he was particularly interested in economic questions. I mean, I think he wanted to, do a lot of big things, like in terms of like a new deal, but and reshape the economy in some ways, but I didn't get the sense he didn't have a lot of, I mean, other than Janet Yellen, he didn't have a lot of economists around. Maybe it didn't interest him, or he just had other priorities. I mean, there's a lot to do as your president, and some people are just more interested in economics and having economists around more than others.
Yeah. So I want to do a kind of a quick pass through some of these titles and get your, uh, get the essence from you of what is in these columns with these interesting titles. But I do want to talk about uh, geopolitics and economics with you for a moment. So we just had the Russians fire off an ICBM at Ukraine. That's pretty scary. Multiple warheads apparently exploded in that town in Ukraine. How do you see? Do you have any thoughts about that and what it might trigger for financial markets as this thing sinks in? This is a pretty big step of them to be firing off ICBMs.
I mean, I really, it's such a, I feel like the consequences for Europe are going to be pretty serious. Um, I just, they're so, I mean, I don't see a good way that this ends anymore. I mean, it doesn't seem like Ukraine is going to have a path. I mean, I'm not an expert in foreign policy, has a good path to victory, and is eventually just going to have to compromise and then let Russia, take some territory. And that's just dangerous in a lot of ways. I think this definitely, poses big problems for European security and the European economy, especially because they've become so dependent. I mean, when you talk to Europeans, I realize they've had such a different post-pandemic experience than us because they've just had these huge energy prices. One of the reasons inflation's come down and we've had a sort of good economy is we've had cheap energy, they haven't. So sort of it doesn't set a good precedent, although I'm not quite sure there's another solution anymore. But at the same time, as I said, I think this really, Europe was already in pretty bad shape with their low productivity and their aging population. And this is just going to be another big sort of kick in the teeth for their economy, which I also am concerned at, just because they're having so much social unrest, is poor growth prospects. It sort of always pours more fuel on that fire. So I said I lived in Europe for a long time, and I really kind of worry about their future.
Do you, have you looked much at Germany's economy? It seems like Germany is in particularly rough shape compared to, what we would expect from Germany. Uh,
Yeah, although not from what I would expect from Germany. I mean, they had some reforms, and I was like, maybe they're getting it together. But what always like sticks in my head about Germany is when I first started working with Merton, is our very first job was to go to Philips, Germany, and try to help them set up a defined contribution pension plan. This again, everything comes down to this, and
mhm.
it's a metaphor for life. And they do not have defined contribution pension plans in Germany. I mean, I remember once on a Council on Foreign Relations junket trying to talk to someone in the government about having more private pension accounts, and they're like, he literally said, "That is crazy. We would never do that." Something every other country is doing. And I remember we tried to set up like default investments for them, and they were just like, the most equity we could possibly have in a pension account is 10%.
Really?
Yeah,
Wow.
there's just nothing in that economy that's open to risk taking. Um, they want to have growth, but they don't want to take risk. And they want to have productivity growth, but they don't want to take risk. And you can't have it that way.
So that's, now what about the UK? You spent a fair amount of time there. You're with the bank. How do you see, and then we have Brexit, uh, which is like, seems like a economic suicide for that um, country. But maybe Brexit never actually did anything in the sense that they just changed the words. It sounded like they actually had separated, but economically, they set up arrangements where nothing fundamental was any different than it had been. Is that your take? It's kind of my feeling, but I'm not sure.
Yeah, I mean, I was always so skeptical of the EU anyway. I personally, if I was British, I wouldn't have voted for Brexit because I just think the economic costs of separating would have not been worth the benefits. But I mean, I'm more optimistic for the UK, not much, but more. Just because they said they have a better risk-taking culture, they're more aligned with our economy, which is probably better for them because I'm bullish on the US economy. Certainly, as I said, more than the European. And as I said, they have a better risk-taking culture. I think right now, if I read labor, everything labor says, they also want to have their cake and eat it too. They want to move all their pension investment. They have this idea that the reason why we're doing better is because of our sort of private equity industry and all the capital that stays here and invests here. So I think they're like, well, if we do that too and encourage pensioners to invest in British private equity, good things are going to happen. I don't really agree with that, but at least they're open to investment. At least like, they invest in stock in their stock market. I mean, that's something.
Right. Well, and have you been keeping an eye on China of late, their economy?
Again, this just proves the rule. It's like they thought they could have this managed growth and never have a downturn and could have 7% growth all the time. Like I think that happens when you're in catch-up phase. It's pretty easy to become poor, especially if you have a lot of labor, and become rich, but staying rich and continuing to be productive, and you can't sustain those growth rates without having a really true market economy. And that means opening yourself up to risk and innovation. And I think they're seeing all the costs to thinking that they can have this perfectly managed growth and perfectly stable growth year to year. It's like, people get very dependent on the on real estate, so they just sort of prop up that market, and eventually, obviously the bottom comes out there. So, it sort of always astounded me that the last 10 years everyone looked at China and thought we should do that. Like even when Biden was starting to pass IRA and CHIPS Act. He's like, you see, China does all this industrial policy and look how much they're growing. And it's like, why are we looking at China for insight on anything? I mean, they make some really bad decisions, bad economic decisions, like the Great Leap Forward or the one child policy. And we're like, yeah, they know how to do things. Like, how did that happen?
Right. Yeah, I've seen estimates where the Chinese population, they're below fertility. I mean, they're below, um, obviously the 2.1 fertility rate. I think they're having fewer children now that the one child policy is over. I think their fertility rate's above one. Uh, the South Korean rate is 0.76. That's the lowest in the world. South Korea is projected to go from 56 million people today to 12 million at the end of the century. I've seen projections for China. They're 1.4 billion now. They could lose like a half a billion people over the course of the century if this continues. On the other hand, I was just looking at some numbers this morning before you got on that China's growth is projected by the World Bank to be 5% this year. So it's not 7, but it's still high. And population growth is 0. Uh, so we're talking about a 5% productivity growth. Right? I mean, sorry. Well, yeah, in per capita terms, we're talking about a 5% growth in per capita GDP. So that's got to be coming from productivity. And
You think?
I guess, I don't know, maybe the numbers aren't any good. And then if you translate this to
I
dollars,
believe they're having positive GDP growth. I'm not sure it's 5, but I believe they're having positive GDP growth. I
yeah.
think that's credible. Mhm.
Well, I was just there on vacation with my wife, and we were in all the three big cities, Hong Kong, Shanghai, and Beijing. We saw essentially no other American tourists.
Mhm.
We saw very few European tourists. We saw lots of malls with Gucci and Armani and these very high-end stores. I mean, every couple blocks in Hong Kong, there was another high-end mall with these stores. Remember, there was an entrance to the subway inside one of these malls. Right next to it was the Armani. You come out of the subway, there's the Armani store. That, but there's nobody in these malls. Basically, all these stores are empty, and you just wonder whether, you know, scaring tourists from coming to China. I think a lot of people are scared because of the politics between the US and China, and has really damaged that economy significantly. And maybe it's it's part of the a long-term problem for China that they're not going to get foreign investment like they have in the past. And then you hear stories about academics who can leaving China from like Hong Kong University, and there seems to be a lot of fear in the people that I interacted with.
Yeah, but didn't you see this coming?
I don't, I didn't, I mean, economies, can grow. I mean, we saw Japan grow super fast, but then they plateaued. Um, but I don't think anybody necessarily saw Xi. I think people, whether or not, I think you have a lot of people in the Chinese economy and also the government trying to figure out what Xi really wants. He may say a few words and then they overreact, and that's really not what he wants. It's like when Mao said, I think, a few words, and all of a sudden we had the Cultural Revolution. I don't think he was like saying, here's exactly what you teenagers and young students should do, and here's where you should send people out into the rice paddy. They just took over from one day to the next based on some words that he spoke. So I couldn't see coming. I think a lot of what we see is idiosyncratic, having to do with who gets into power. And I think Putin is an idiosyncratic. I don't think it's inevitable that we would have war with Russia because NATO expanded. I think NATO expanded because of Putin,
Mhm.
Putin. So I think my view of this stuff is largely based on who actually ends up in power, and a lot of that has to do with people that have very strong, are willing to risk a lot to get that power.
Yeah, but who's in power matters a lot more if you don't have a market economy. I mean, it matters even if you do have a
Yeah,
market economy,
yeah,
but I mean, what G wants matters so much because he really is in control of the economy or tries to be. So
yeah.
market discipline tends to or I went to Russia again. I'm lazy about traveling, so I tend to do Council on Foreign Relations junkets when they invite me. So in 2015, I went to Russia with them, and they were in a recession because of the sanctions around Crimea, and I expected everyone to be really mad at Putin because his escapades had brought them into a recession, but they were like very pro Putin, and they were kind of like, we're always in a recession. Things have never been good. I kind of naively thought, well, Russians were just so thrilled that the Cold War ended and they got capitalism because who doesn't want capitalism? And they were all like, no, it was bad under communism and it was bad under capitalism. And it's just kind of always bad. But the difference is Putin makes us feel like there was a big player on the world stage again. Like we're important again. People kept telling me how humiliating they found it was losing the Cold War. And the economy is always bad, but now they feel like they're like important again.
Yeah. Well, I think they're important in a pretty bad way. Yeah, yeah.
Yeah. Well,
Important.
but yeah. I mean, it's just that they will put up with things we wouldn't. And as I said, I mean, I guess Russia does technically have a market economy, but there's like if Trump did this sort of thing and brought us into that bad a recession and made us global pariahs, there would be consequences. Um,
Unless he had the power to lock us up or shoot us. I mean, that if he really went that far, which some people, in this country now fear that he'll be that extreme. But in Putin, I think it's a matter of ruling out of fear. I mean, people are scared for their lives, and we saw this with Navalny being murdered by him and other people.
yeah.
So
I think some people though genuinely like I just think they just sort of are like there was never a good time. There was never they don't see as there was ever a benevolent ruler. I
let me see if I can, yeah, if I can put this in a different, more broader. If we were to try and kind of quantify macroeconomic risk, what fraction would be due to uh, bad leaders in a kind of coming into play in a country? Uh, Chavez in Venezuela,
yeah.
Morales in Bolivia. You know, think about,
Well, with an autocratic ruler, it's much higher, particularly if you don't have a market economy, who can properly, well, I guess markets eventually come to bite you no matter what. But I think the US having a bad president, it's a lot less of a risk of that being bad for the economy than it is if you have an autocrat because there's more accountability.
yeah, the autocrat can take down a market economy, and as we're seeing in China to some extent, right? They
Yeah, of
can,
course. Like in the case of Singapore, if you have like a benevolent or not benevolent, but like smart autocrat who knows how to plan, you can also get things done faster. So, but those are few and far between.
yeah. Well, anyway, let's go through this list of pretty cool articles. How about demystifying the Ivies? What is that about?
Was that a council? That was a city journal. Yeah. So I'm actually working on this now as well for Bloomberg.
Mhm.
That I see the problem with the Ivies is, they became a very large premium on going to college, and they became an enormous premium on going to an elite college or university. Um, and so I think so obviously there's far more demand for these slots than there is supply and more demand of very qualified people. So it's it's sort of I think that a lot of these Ivies started to see their mission as curating the world's elite and picking people based on some sort of social or political considerations more than just pure merit. Because I mean, honestly, there were enough people around who had pure merit. And I think this power ultimately corrupted them and made them much more political and sort of they lost a lot of their credibility. And I think the best thing I think that I kind of welcome all the problems they've had lately in a lot of ways. Anyway, obviously I went to Columbia for 6 years and I was very sad about what's happening there, is that I think if we lived in a world like other countries, even in Canada, or even I think other parts of the country, people just sort of go to the a local university, and they're not like, I have to go to the best one, and they get a great education and they do fine. So maybe if we just democratized this idea that there's a handful of universities that are worth going to, that and took away some of that power, they could get back to being, what they're good at, which is great research universities or a collection of very smart people, rather than being like, it is our job to mint the elite and we choose who the elite is. I think that's just inherently a corrupting, something that corrupted the sort of university system. And we should go back to, you know what, you can do just as well in life if you go to Texas A&M as you do Harvard.
Well, I think, I mean, that's true for lots and lots of people that, and I've seen personally, people that went to Princeton, went to Harvard for grad school, or went to Harvard Law School, went to the clerked in the bet with the best judge, got the best job in a top law firm, and then had a nervous breakdown the next day because the whole thing was they didn't expect to work 60 hours a week at the end of that whole, or 80 hours a week, the end of the whole process. And now they're teaching kindergarten. And
Yeah,
so,
they probably also were chasing status and not like what truly makes them happy. Maybe they would have been happier going to football games at Texas A&M than Harvard all along, and
yeah,
just would have done it. And the good thing is, part of the upside of the elite overproduction, like a lot of really smart people do PhDs and there's not enough jobs for them at elite universities, means universities all over the country has really good, brilliant professors because there's not enough slots for them at top schools either. So, I mean, I don't know
yeah,
why I keep bringing up Texas A&M, but they have a fantastic economics department. I know several people in that, and they're all like top tier academics. I mean, you can get a great
yeah,
economics education there.
yeah. No, I think, yeah, absolutely. They do have a very good group. Um, what about sovereign wealth clubs? What about that? What's that about?
Sovereign wealth flubs? Can you remind me what that's about? I write high volume, so I can't always remember.
Right. So, you know, so Trump apparently rolled out the idea of starting a sovereign wealth fund. Members of Biden's team
Okay.
were pushing the same idea. We normally associate countries like Norway and Singapore with these funds, um, but America already has a sovereign wealth fund.
Oh, that's right.
Yeah,
Yes, I remember this one now. Yeah, so this is the idea that, which is effectively we're going to take on leverage to invest in something, which is we're a debtor nation. So if we're starting a sovereign wealth fund, we're taking out debt to invest in something. Inherently, that always gets very political. And these things tend to have a lower rate of return. So it's not that. But I think in that article, I pointed out that to some degree, we already do have a sovereign wealth fund. State and local pensions, fully funded pensions, they invest in some good things, some bad things, but I'm of the mind anyway, it's not legally on the books that ultimately the federal government is going to bail them out if they get into trouble. So to some degree, that is our sovereign wealth fund.
yeah, and I think they probably are in terms of a fiscal gap. If you include all their obligations and assets, including their wealth funds, their pension funds, that they are in big trouble. I mean, the state of Illinois is a good example. I think.
Yeah. And that does not bode well for the government investing assets on our behalf.
Right.
I think it's only going to get worse. I mean, not that I mean, some of them have like 10, 15% at most in private equity or VC. And there's evidence that they didn't get maybe the best vintages or the best funds, and no one really knows what they're worth, and they're not getting their money back now. I mean, I think that's just, I don't know
Yeah.
why
I
the UK is
mean,
emulating this at all, but there you
this
go.
entire idea of private equity funds, that everybody can invest in private equity funds or just invest with an investor who's going to, or a set of investors who are going to beat the market. Not everybody can beat the market. So, you know, large scale uh, funds can hold the market, and that's great. But if they try and beat the market, they're going to take on extra risk and they're going to take on extra fees. 90% of the this study, Thorsten Slope just came out with this. He's a chief economist with Apollo. Was looking at the S&P reports. 90% of the equity fund managers have underperformed the market over recent years at a fee, at a cost.
Mhm.
So What about inequality isn't the problem, uneven growth is? I'd like to talk to you about a really powerful financial planning tool to help you make smart retirement and other critical financial decisions. It's a tool that factors in all your financial data and shows you what you can sustainably spend every year for the rest of your life. That tool is my software company's Maxify Planner. It's incredibly powerful, it's accurate, and it's easy to use. Maxify takes the guesswork out of financial decisions at every stage of life. Its focus is on raising, de-risking, and sustaining your living standard. Maxify lets you run what-if scenarios to see how your finances will change in taking new jobs, buying a home, doing Roth conversions, retiring early, downsizing, investing more in the market, you name it. Knowing the impact of these decisions before you make them is the secret to making smarter decisions. And it's also the secret to what we all seek, which is financial peace of mind. So please visit Maxify.com today to start planning. That's Maxify with an I, Maxify.com, Maxify.com. Now let's get back to the podcast.
Is this for Bloomberg?
I think this was Bloomberg.
Mhm.
Yes, Bloomberg opinion.
Could you read the first sentence just so I can remember?
Growing economic inequality is either a major issue of our time or a defining challenge of our time. Given America's recent experience, however, I would like to call for timeout. And then you say, after years of narrowing of a widening gap between the rich and the poor in the U.S., income inequality is finally narrowing, and yet few Americans are happy about the state of the economy. Inequality shrank only because
Yeah, so I feel like for the last like 15 years or so, all we heard about was inequality was the biggest problem, and it was the problem to be solved. We never talked about growth, we never talked about productivity, which is inequality, which I agree, has issues. Um, but during the post-pandemic economy, we actually did see inequality narrow significantly. Um, People on the lower end of the income spectrum did have bigger wage gains. Um, but that was but everyone kind of at the same time got poorer because of inflation. So I think that proved that our obsession with inequality wasn't in the end productive. Because it's not just about inequality. We narrowed inequality, but no one thought it was an economic success. In fact, everyone was quite unhappy. Because even if people at the lower end of the income spectrum had relatively higher gains, just because the nature of the goods they buy or the fact they tend to be liquidity constrained to begin with meant inflation really probably in a lot of ways still did hurt them more, even if they had bigger real wage gains. So I think I was writing that column to be like, we need to like stop obsessing about inequality for its own sake and think more about the health of the economy.
yeah, and I would say the real concern is inequality in spending power, that
Yeah.
including your ability to leave bequests, that's really, and that inequality like in wages and inequality in wealth and inequality in income, they're not capturing the fiscal side, and the fiscal system has like 500 programs, federal and state, that take from people of means and give it to people that don't have means. Of course, they do it in a crazy way where they say to poor people, hey, here's your dole, here's your allotment this year, and if you earn too much money, you'll lose your food stamps, you'll lose your Medicaid, you'll lose your health care. Well, Medicaid is health care. You'll lose your supplemental security income if you're on that. You'll lose your housing, Section 8 housing, and you also have to pay more taxes, federal taxes, and you'll lose your Obamacare subsidies, some of those. It all adds up to having about a third of the poor in marginal tax brackets, lifetime effective marginal tax brackets above 60%. So we're locking the poor into poverty. So that's part of, I think, our, endemic poverty problem, endemic, inequality problem is that we have decided we want to have poor people.
Yeah. Well, I'm working on a new book exploring how, I mean, we keep low-income people poor because we pretty much shut them out of any sort of meaningful risk taking. I think we feel like we have to remove risk from their lives, but pretty much we just remove any upside, and you only get rich experiencing upside risk.
Yeah,
Or
and
you,
also, if you think about it, here's something to think. This may not have come across and you're thinking about Social Security. You have Social Security is taxing us up to about $170,000 now.
Hmm?
So, uh, and so for people who are higher earners, and there are a good chunk, they're not paying any Social Security after that. So they get to accumulate wealth. They're not having to pay 12.4% of their pay to the government that they could otherwise be banking, putting into the market. So, and then when they die, so they don't have the upside of the market because they're basically locked out of the market because they don't have enough wherewithal to save more in the market. But then also when they die, and a lot of poor people die young, they have no wealth to leave to their kids because they've been de-wealthed, if you like, into retirement. We've transformed. Imagine we didn't have Social Security at all. Everybody was saving for themselves. Then you'd have poor people dying as they do earlier than rich people, and so their kids would have a better chance of inheriting. And Joe Stiglitz actually wrote a paper decades ago showing that um, an estate tax could actually be raise inequality because it would deprive poor people of, and this is in a world without Social Security, would deprive poor people of inheriting from their parents who would die early, compared to the rich whose parents would die late and get to spend more of their money. So, and that actually, and Social Security makes what might be a inheritance process equalizing and makes it the opposite.
yeah, as I said, because that becomes almost all of their wealth is in Social Security.
Yeah.
And they have no way, not only bequeathing it, but they have no way of investing. I mean, that was the irony of when they tried to privatize Social Security for a hot second in the, 20 years, more than 20 years ago now, is everyone thought, oh, it makes people so vulnerable, but lower income people would have been really the biggest beneficiaries of it.
Yeah, absolutely. Yeah. And well, we'll have to talk about Social Security reform at some point, but my plan would be to retire the old system, put in a new system that's fully funded, and you're investing in a global index. So it's not some private equity investors running this fund, uh, but then you'd accumulate wealth and uh, it would work that way. And you could also leave it if you die early.
This is an aside. Isn't it just bizarre how like you talk to people in private equity or people in the pension space now who say like the biggest priority now is, or not the biggest priority, but like we need to figure out how to let retail investors invest in private equity. I mean, I always thought we thought transparency and, well-regulated assets were important. And now everyone's like, yeah, we should have stuff that is completely in the shadows and has no market return and let everyone in on this. I mean, it's so bizarre to me.
Me too. And I think these people are charging it. If they're really good investors, they're all Warren Buffett. And Warren Buffett, I think, has underperformed the S&P over the last 15 years, from what I gather. He's obviously been fantastic for a long period over the long haul. But, if you're really good, you're going to charge a really high fee. So then you're going to take out the entire uh, value of investing with the person if they have something special. But they might also have just had a track record that's based on luck, right? So,
Yeah.
but let me ask you about this one. What do graduates of Yale Law School know about economics?
Yeah, this one I feel like I've contributed to the world an expression now, as I call it. My editor might have come up with the expression, the Yale Law School of Economics, which now I've noticed everyone's using. Like Larry Summers keeps using it now as a term of derision, and I'm so proud, because it came from this column where I've noticed, and this is on the left and the right. There's these people who graduate from Yale Law School who decide like they're going to do economics, and it's like JD Vance, Josh Hawley, Lena Khan, Jennifer Harris, um, a bunch of the people who are advising Kamala Harris. They all have like this very sort of strange view of how the economy works that is completely different from the way you or I were ever trained to think about things. It's the main thing is, the decline in manufacturing jobs was largely this huge policy error that needs to be remedied. Skepticism of big business, skepticism of global trade in general, sort of, I guess, a wholesale rejection of, I guess, what we call neoliberalism. And I think at the core of this is this sort of belief that the economy is inherently zero sum. I think what you learn when you're an economist is you're always searching for ways to grow the pie. Find opportunities, understand there's often winners or losers to an economy, but try to find policies that ultimately grow prosperity. So it's not always a zero-sum game, but they don't think like economists, yet they sort of have very strong economic views and a view of the world, and they're just becoming incredibly influential.
And my sense is that Harris had basically lawyers advising her on the economy. That's what I was told. I actually tried to volunteer to provide some ideas, but they said no, we're fine. And then I found out that she had no real economists on her team, but maybe I'm wrong in that. I
Exactly.
just don't know. Yeah.
Yeah, I
The,
mean, this is
yeah.
this is becoming a thing. I'm disappointed to hear that, but not at all surprised.
Right. Um, the How do you see the stock market these days? You've written about equity markets, and here we are. It's pretty high. Would you be telling people you probably don't forecast the stock market?
I'm too
Uh,
much of an efficient markets person. It does feel like a little hot to me. I mean, I still like I'm a big believer in, like, you have a strategy and you stick with it. So I'm certainly not selling shares. And I'm still like, my 401k or 403b accounts are still buying shares. And as I add my savings, I guess I am, because but it does feel like a little hot. I think also the concentration worries me, that people have gotten used to like fairly high growth and fairly low volatility. And I think that phase is over. If nothing else, we're entering a phase of, I think, enhanced innovation. And I'm just Schumpeterian this way, and that I feel like that's very exciting, and we come out in a better place. But there's a lot of creative destruction and volatility along the way, and a lot of bad bets that get made that turn out not to be so great. So I think we're about to head into a very sort of high growth, high vol period. And so people have to sort of, I guess, realize what they're getting with equity investing.
yeah. So and right now you can get a 30-year inflation index bond. It's yielding 2.3% as we speak. It seems like that's for people in their retirement years who want to maintain some kind of a floor to their living standard. This is the way to building a tips ladder that
Mhm.
would support your basic needs in retirement, and then maybe just do some upside investing where you just have a pot of money in the market, and you let it ride for a while and then systematically take it out, but you never spend out of anything that is in that pot until you've converted it to tips. That's one simple means of having just upside risk while still investing in the market.
That's exactly how I think people should invest their 401ks. Like, exactly. And even after they retire, what their strategy should be. As I said, we figured it out, just no one listens to us.
Well, you're going to need to run for president. I think that might be the answer, no?
Oh no, I'm working on, like, as I said, I think I told you I'm working on for Manhattan Institute, my plan for retirement. And it's like all the things no one wants to hear. Like, how can we get people to work longer? How can we get people less make Social Security something people can rely on, but also less dependent on it? Like, none of the things people want to hear. Because you get these people who keep insisting that it's inhumane to make people work longer, when it's just like, I understand some people physically can't work longer or they're ill, but I don't understand how that turns into everyone should retire early.
Yeah, almost everybody's retiring before 65,
Mhm.
and they're taking Social Security immediately, and the typical household's leaving $182,000 in present value on on the table in terms of taking Social Security benefits too early, or the wrong benefits, or not taking certain benefits that they could have taken because they don't know.
Mhm.
So that's huge. I mean, Uh,
Yeah.
yeah. And yeah, well, let's talk now at the close about your book about the what an economist walks into a brothel.
Mhm.
Go for it.
Also,
Tell us about
also
that.
about retirement, believe it or not.
Really?
So I had this idea that to understand retirement problem, people had to have a basic understanding of financial economics. So the idea of the book was to do for financial economics what Freakonomics did for, say, applied micro, and tell cookie stories that illustrate these principles of finance. Although I didn't have a research portfolio like Steve Levitt did, so I did reporting because I'd worked in media. And long story, ended up at the Bunny Ranch doing some reporting there about negotiation, and just sort of learned how their prices work. And I think, as you know, there's sort of one central lesson or theme of finance that sort of undergirds all asset pricing. And it's like the most obvious thing, and it's so important, but like no one seems to accept it's true, which is, no risk, no reward. So the idea of the book was sort of exploring how risk is such a big component of price and how you have to pay to reduce risk. So if you want a low risk asset, you get a lower return. And that was, I think, the Bitcoin column you referred to earlier, is everyone thinks it's supposed to be this high return asset, but also be this ultimate safe asset. And you can't have both. And this is how you know something screwy is going on. And this is ultimately what comes down to every financial scam, right? Is that people think that they can get a high return and no risk.
So what does this have to do with the brothel, though?
Oh, so I got into pricing of sex work, like really got into how pricing is. And you do see that if say safer sex transactions tend to be a lot more expensive than riskier ones.
Oh, okay. Well, that's cool.
So,
Interesting.
it's isolating a risk premium on both sides too, because the women who work in the brothel have to pay a very large chunk of their wages to work in a legal brothel, but they also get a lot more safety. So it's and so what the pimp, I thought was an interesting play on what I think of as a pimp, because I always think of them as pushing people into risky situations. But Dennis Hoff, who owned the Bunny Ranch, actually extracted a premium from buyers and sellers for providing a safe transaction.
Really cool. So how did that book do? Let me
It
tell
did well.
everybody.
It sold a lot. I think it's still selling.
Great. So the exact title is
An economist walks into a brothel and other unexpected places to understand risk.
cool.
I had such a
So
fun time writing it. I mean, I also like I went to like a big wave surfing risk conference. They have an annual risk conference in Hawaii. Like, who knew?
cool. That's great. We're going to get you back. Thank you so much. This has been delightful.
Oh, thanks for having me. It's been so much fun talking.
Yeah, and everybody keep your eye on Allison's writings in a variety of different outlets. Just keep her, go to her Manhattan Institute website, and you'll be able to, read them. They're terrific. So once again, Allison, thanks again.
Oh, thanks for having me.